Welcome back to another episode of the Wealth Building Strategies podcast. I'm your host, Jeremy Constantino, and today we are continuing our three-part series entitled, What is a Real Estate Syndication? Today, we're talking part two. Part two is the benefits of investing into a commercial real estate syndication. So in part one, if you haven't listened already, I give a brief overview of what is the structure and the overview of a real estate syndication. And then after this episode, for number three, we are going to be talking about underwriting and the roles, responsibilities of limited partner and how to underwrite commercial real estate syndication opportunities. So without further ado, why? Why invest? Why should an investor like you, maybe listening to this show, why would you consider investing in a commercial real estate syndication? There are so many reasons why. And I actually have put together an ebook called Real Estate Syndication 101. If you haven't already downloaded the ebook, take a look at it. In there, I describe and I outline 18 different benefits, 18 reasons why you should consider investing it passively in a commercial real estate syndication. And so today, I'm just going to talk about a couple of these, and I'm actually going to talk about some that I didn't even put into my ebook because there's so many benefits of it, and I absolutely love this. And so the first question, the first benefit, and the first question we ask is, well, why commercial real estate as opposed to investing in the stock market? A couple of reasons. The first reason and the simplest answer is the commercial real estate outperforms the stock market and has outperformed the stock market historically. Real estate, commercial real estate, passively investing, seeing 10, 12, 15% returns on investment consistently. Whereas in the stock market, you're 6, 7, 8%. So you're going to get a higher return on investment, just completely. This is broadly speaking, broad stock markets, broad commercial real estate is outperforming financially. Okay, that's number one. The second reason is more important to me, and I think to the investors and the listeners out here, and that is downside protection. And what do I mean by downside protection? I'm comparing commercial real estate versus the stock market. The stock market tomorrow, yesterday, today, the stock market could collapse and all the returns and all the value you could drop 50, 60, 70, 80%. You could lose it all within a matter of moments. Something that's completely out of your control, and it is completely out of the control of the actual company. So if you own Apple, Google, Tesla, and you own these shares, you're expected to have your returns and your value of your share be backed by the P&L and the balance sheet of those companies. But unfortunately, it is not. It is the stock market is impacted by the global markets and the media and the puppet masters out there. And what happens is that the fluctuations in the market are based on emotions and feelings. And unfortunately for us investors, no matter how much due diligence we do on Apple, Tesla, and we look at their portfolio, we look at their P&L statements and their balance sheets and their companies, regardless of how good they're doing, it doesn't matter if Elon Musk make a tweet, or if there's a bombing in another part of a country, the stock market could plummet. It could go up. The value goes up and down based on subjective feelings. Compare that to investing in a real estate syndication on a specific property or a portfolio or a fund of properties. The value back to the investor is a direct function of the cash flow and the actual sales that take place on the property. So if you own a property through a real estate syndication and the terms are you get 50%, 60%, 80% of the profits, that's what you get. So the cash flow coming in from the tenants or from fixing up a property and selling it, that cash flow gets distributed based on the agreements, the legal documents, and the ownership agreements of the syndication. Regardless of what is going on in the world and what type of bombing and what type of tweet, that property is going to perform based on the specific local market conditions, and people still need places to live in the apartment complexes. People still use office and retail and industrial spaces. Real estate's everywhere, and it's not going away. And the people paying the rent is based on the specific local conditions, not based on global fears and global tweets. So that's the second reason, is that the downside protection is simply that the physical asset is what is backing the investment. So the worst case scenario is they're still building, there's still a structure there, there's still a real estate, and that has tangible worth. So even if the building gets caught on fire, there's insurance to protect it. Even if some tenants move out, there's still some tenants there and there's still a structure there. And so the downside is limited. Whereas in the stock market, there is no downside and there could be a loss. And that is exactly what we've seen over the last year. Is for my case, I invest in Apple and Amazon and Google, and those companies have made billions of dollars in net over the last year. And as a stock investor, my portfolio went down 30, 40, 50%, and I lost money, whereas they're making money, and there's no correlation for how much money they make and how much we make. And yeah, sometimes there's a little bit of dividends, but we don't see that. Anyway, so that's the second reason why commercial real estate over stocks. And the third reason is I alluded it to right now, is about diversification. Or I'm sorry, not diversification, about dividends. So the dividends coming from stock market are very, very, very small. Whereas in real estate, renting out commercial real estate, there could be significant cash flow on a monthly basis going back to the investors. So that's the third reason, strong cash flow. Okay, that's why commercial real estate. So now the next question is, why get involved into private equity and some of these smaller syndications with smaller general partners like myself and other general partners and syndicators out there, as opposed to investing into, again, publicly traded real estate investment trust or some of these other funds that are more publicly made available. So why private versus public? And the answer is simple, is that when more investors come to a deal, the returns are simply diluted. So when it's a small group of investors, can share the profits, and we could all make a lot more profits and higher returns on private deals versus public deals. And I've seen this, as the larger the syndication grows and the larger there's more access to the deal, the returns, the profit returns are in the 12, 13, 14% return on investment. Whereas the smaller deals, great opportunities, 20, 30% returns on investment, 40%. And in my case, my personal returns in real estate investment are, out of all my projects, are around 50, I think it's 57% is my average ROI. Smaller deals, find good deals, and we just invest with a couple partners. So that's why private syndications are very desirable. Okay, now that I've said all that about private versus public, stocks versus real estate, now the next question is, well, why should I invest as a passive investor versus just buying the property myself. Then I get all the profits and I don't have to share with anybody. I can just do it myself. That's a very good question. And that question is, should you be an active real estate investor or should you be a passive investor? Or you could be both. So I'm personally invested passively in many real estate deals all across the country. And then I'm also an active real estate investor where I find the property, I look at the deal, I do the underwriting, I negotiate with the real estate agents, then I manage the deal, manage the tenants, and then I look to sell the deal. So that's active investing. So I do both. And the reasons for being a passive investor, and again, if you haven't checked out my book, my ebook, I list out 18 different reasons on why you should be why you should consider passively investing. And for me, my first passive investment deal that I got a part of was a fantastic retail 3-story office building in McKinney, Texas, growing McKinney, downtown McKinney. So it's a historic building, fantastic piece of real estate. And I didn't have the down payment to afford something like that, but I had enough to participate as a limited partner in that investment. And we so that was in 2000, I think 2019, 2018. And right now we just we recently sold. So over these last 3-4 years, the best thing about investing in that property was I didn't do any work. I didn't do any work at all. All I did literally was in the mail, I would get my cash flow check and have to deposit my cash flow check into the bank. That's it. And so somebody like myself, somebody coming from commercial real estate, I understand all of the hard work that it takes to acquire a property at a good deal, get the property leased up and fixed up and rent it out and making the repairs and managing all that. That is a hard work. And it takes a tremendous amount of team with a lot of experience to do that. And to think that as an individual that I could go buy a commercial retail strip center, with a Kroger on it, or an industrial park, or a big tall office building, that I could do that by myself. There's so much involved that you have to leverage the expertise of all the different skilled real estate professionals out there. And thus, that was probably the best feeling of just getting cash flow coming in from a fantastic real estate asset in a great appreciating area. And there was no worry. I had no worry that the price and the value of that asset was going to fluctuate just like the stinking stock market, fluctuating up and down every week. I hate looking at my real estate invest or on my stock market investments, because you're losing six figures. So you lost six figures today, you gain six figures tomorrow, and it's ridiculous. The volatility and the the high probability of getting your portfolio wiped out in an instant is just insane. And so experiencing the security of having your money invested, my money invested in a fantastic real estate asset, is something undescribable. And I appreciate it now even more for these many years that I've been in real estate, active, and understanding that. So I have even moved, and because of that experience, that fantastic experience of being a limited partner in that commercial deal, I have actually liquidated all of my stock market. So I've had a nice nest egg that I've saved up, because I had a nice 401k with my previous employer, moved that over to now to a solo 401k, sold all my stocks, sold them all. And now what I've done over these last couple months is now I have invested and just started diversifying into other general partners and other lead syndicators across the country. And I think I've invested one, two, three. I've invested with five other general partners over the last couple months, and now my funds are diversified into short-term rental fund. I'm invested into industrial space. I'm invested into office spaces. I've invested into multifamily deals. I'm invested in the Northeast, in the South. So I'm invested diversified geographically, and now I've diversified in via asset classes. So I've taken my funds from the stock market, now moved them into only commercial real estate, hard physical assets, and couldn't be happier. And that's why, and that this is the reason why this podcast exists, is to educate you guys, to share, to explain to you guys that you can get out of that crazy stock market casino and put your real estate and put your hard-earned money into very safe, secure commercial real estate assets across the country. Get diversified, and I'm excited for the upside potential on these deals. So, getting kind of excited here about real estate syndication and why to do it, and I couldn't recommend it more. So stay tuned. This is a wrap for what is a real estate syndication part 2, the benefits of investing into commercial real estate syndication. And the next session, we're going to talk a little bit about underwriting and due diligence. So stay tuned to the Wealth Building Strategies podcast. And that's a wrap for this episode.